Jan, thank you very much for agreeing to talk to us. I wanted to take you back in time a little bit. We first met in the mid-1990s, and it was in response to a paper you wrote on the Asian financial crisis, which I always thought was the best paper actually done on the crisis. And it seems to me that it's worth revisiting that period because we're talking about capital account liberalization here in China, and the renminbi internationalization. So some of the lessons of that period seem to have been lost somewhat.
I think so, Marshall. It's a very interesting period, and it's also, as you mentioned, very interesting from the point of view of the current discussions. The idea that somehow or other China has gone through a very sharp change within its own policy, I think, is belied by that period. Because the 97 crisis was crucial for all Asian economies. If you look at the trade patterns before the crisis, primarily you had an increasing amount of intra-regional trade, that is the so-called little tigers in the region, traded primarily amongst themselves and then had final products that were sold into the US. The crisis broke down that system. And as a result, China also had an exchange rate adjustment about this time, and subsequently became more or less the center of the interregional trading pattern. So it represented a real break in terms of regional developments and global trade balances. It's more or less from that time, dates from around 2000, 2001, that you start seeing China generating very large global imbalances. So we now talk about global imbalances as being one of the basic causes of the crisis. It goes back to the response to that period. Now, if you look at the other Asian economies, more or less they did the same thing that China did. We talk about China's large accumulation of foreign exchange reserves. More or less all of the Asian economies did the same thing. But the crucial point is that China became sort of the center point of trade within the area. So I think this is looking backwards, the first point that's important, that is, it starts a very different period in terms of Chinese development.
And of course, it was important as well that capital accumulation that all these countries engaged in was, in fact, an understandable response given the, if you like, the depredations of speculative Western capital directed on their economy.
Well, I think this is why it is important, because the crisis was generated primarily by the fact that these smaller Asian economies, what we used to call the little tigers, we're talking now about Thailand, Malaysia, Indonesia, and then subsequently Korea joined in the party, primarily were economies that were closed to international capital movements, but had started to open. And as a result, those international capital movements were driving what eventually became a very large increase in investment balances in these countries. So we now talk about China having a very large ratio of investment in GDP as being unsustainable. If we go back to that period, the same thing was true of Thailand, the same thing was true of Malaysia and all of these other countries. And we said, well, is this sustainable? Well, we now know the answer, that it may have been sustainable, but once you opened your capital accounts to foreign investment, and much of this was foreign investment. Take, for example, Thailand. We talked about Thailand having a very large investment in real estate. Sounds familiar?
Mm-hmm.
Most of that real estate was effectively driven by U.S. foreign direct investment. And it's U.S. corporations who came in and built these very large real estate complexes in Thailand. Now, everybody believed that this was sustainable. Sustainable why? Well, most of these countries had very strong external positions. They had surpluses on their trade accounts. Most of them had surpluses on their current accounts. So the idea was that, okay, they were earning the dollars by selling into the U.S. market that they could use to pay off the interest burden from the capital inflows. Now, we discovered that something there went wrong. What went wrong? Well, very simply, the argument was that this was not a risky exposure because of the borrowing was in US dollars, the sales of their exports was into the US in US dollars, so that they were what we called implicitly hedged. Mm-hmm. Okay, you have your dollar liabilities, you have your dollar assets, and more or less they match. Well, the problem was that, again, if you take a country like Thailand, where the crisis emerged first, Thailand was running rates of export expansion in double digits, 15, just almost at some stages 20% per year. Okay? So if you're expanding at 20% per year in terms of your exports, you're expanding your dollar earnings at 20% per year, you can expand your foreign capital imports at a very, very high rate. In 1996 and 1997, all of a sudden, the export coefficients of all of these countries collapsed. Okay, Thailand went, as I said, from expanding exports at 20% a year down to 3 or 4%. Okay, so you were matched, you had a currency hedge implicit, but the problem was you didn't have an income match. So suddenly the income that you needed to pay off the foreign loans was no longer there. And this was basically the explanation of why Thailand got in difficulty so quickly, and an expression of the risks that are involved in allowing opening of your external capital account, even when you believe that you're fully hedged. When you believe that there is no risk involved, there are risks in this sort of policy.
And there was another interesting aspect to that paper, which I remember, because you actually dug into the instruments that they allegedly used to allegedly hedge their currency exposures. And in fact, this is a case where past meets prologue. You had yet again some toxic derivatives being sold to these countries by Western investment banks, which actually had the effect of exacerbating the crisis.
Yeah, the point was that if you look at the way, I mean, we normally think about capital flows, unfortunately, in much too physical terms. All right, we think of somebody picking up a dollar in New York, putting it in an envelope, and sending it to Asia. In fact, this is not the way capital flows in general occur. And one of the characteristics of the Asian crisis was that most of the capital transfers, in fact, took place by means of derivative structures. Now, the second part of that is not only the innovation in terms of using the capital transfers, in terms of what were basically structures in which you were looking at total return swaps. Mm-hmm. And basically a total return swap simply says that what I'm doing is borrowing money at a fixed rate against a variable rate of return, which includes not only the interest carry, but the changes in the capital value. Okay, so you're
that was
not
your kicker.
that was the kicker. So it's not only that you're exposed in terms of interest rate differentials. If you have a very large change in asset prices, you may find yourself with a very, very large loss, and this is the factor which played out in terms of these instruments. But the second point which I want to bring up is that most of the Asian countries, in fact, participated actively in this process. They participated actively in the process by setting up offshore instruments whereby you could use these derivative contracts in order to transfer funds. Now, Malaysia was one of the major sources of this, and we know that when the crisis broke, instantly Malaysia shut down these offshore centers and instituted capital controls. And one of the important points is that Malaysia was one of the countries that survived the crisis with the least loss in terms of domestic GDP growth. The other is that if you look at Thailand, Thailand had an active policy of setting up what was supposed to be called the Bangkok Offshore Financial Center. And it's interesting that we're here in Hong Kong. Mm. The idea behind the Bangkok Center was that Hong Kong had served as the financial center for financing the growth of the little tigers. Yeah. And the Thai government said, well, why should Hong Kong get all the benefit of the rents that are generated by the financial services sector?
We can all have financial entrepreneurs everywhere, actually.
That's right. So that Thailand set up the Bangkok Center with the idea that, well, Hong Kong had financed Philippines, it had financed Indonesia, it had financed Malaysia, it had financed Thailand, but there would now be another tier of developing countries. So eventually Laos, Vietnam, Burma would all open up, and Bangkok was going to be the center which was going to funnel the capital from the developed countries into these new, what were then going to become the newly developing Asian economies. Now, what in the end happened was that, again, through these derivative structures, the Thai banks would borrow in terms of total return swaps and then on lend effectively into Thailand, so that you ended up with a lot of the Thai corporates borrowing in US dollars without that implicit currency hedge, because as if you're an exporter, you're earning your revenues in dollars, it's no problem. But if you're a Thai corporate and you're developing and selling inside the Thai market, your revenues are in Thai baht, you've borrowed from the bank either in US dollars or borrowed from the bank in Thai baht, and the Thai bank has borrowed in US dollars, so that you ended up with very large currency mismatches.
And of course, once and this is of course again a byproduct of capital account convertibility, because the minute you introduce that, you actually start to create the possibility for regulatory arbitrage. At least if you've got control of the capital account, you can keep control of what the bankers can do. And as we know now, they've got to be controlled and held in harness fairly closely.
Exactly. Now, again, this is one of the areas in which the derivatives tended a little bit to mask these particular problems. Because if you look at the domestic lending, now if you were a Thai bank, you could be lending in Thai baht to a corporate, and you could say, okay, I have no risk exposure. It's the bank that has the exposure. So if you focus on just one part of the financing process, you miss the fact that you are generating, as a result of the open capital account, you're generating these risks which are not always obvious to the regulators. And in particular, this is something which, again, going back to Thailand, the Thai Central Bank tended to recognize that it had a difficulty, and this is, if we go back to the genesis of the crisis, the central bank was in fact operating in the non-deliverable forward market for the Thai baht, because it recognized that eventually there was going to be, there was pressure on the currency, and they were trying to maintain the currency within the stabilized exchange rate band which they had set up. Now, the difficulty with this is that you look at any transaction, there's always another side to the transaction. So if the Thai Central Bank is buying non-deliverable forwards from a counterparty, and it turns out in that case JP Morgan happened to be the counterparty, and JP Morgan happened to be doing 80% of the non-deliverable forward market, it says by definition the central bank is exposing its balance sheet to the counterparty. Now, if you're a counterparty and you're expecting that there's going to be difficulty, it becomes quite easy to speculate against the stability of the currency. So, in fact, in this particular case, while many people blamed hedge funds, in fact, it was not so much the hedge funds that were at the basis of this. It was, in fact, the trading desks of the large U.S. financial institutions.
Some things never change.